Bitcoin whales have scooped up 34,000 Bitcoin since the December dump. So institutions dumped Bitcoin in late December after its peak high, but they're back to buying it below 100 grand. So to me, this is all just consolidation under 100. When you really zoom out and you look at this on like a monthly basis, we had a run to 100 and then we pop back down below it. This is all just consolidation before we finally blast past 100, in my opinion. So more than 34,000 Bitcoin worth about 3.2 billion have been accumulated by institutional investors, providing buying pressure for the current recovery in Bitcoin. Blocktrend's head of research wrote in a January 8th CryptoQuant post. He said the buy-up came after wallets holding between 1,000 and 10,000 Bitcoin dumped 79,000 Bitcoin in the week after December 21st, days after it hit a peak of over 108K. On December 17th, amid the U.S. Federal Reserve interest rate cut, which ended up generating a 15% correction. He added that large players took advantage of the consolidation, have started making big trades broken down into multiple smaller orders, accumulating Bitcoin with a price below 95K. So this is something worth mentioning, is that yes, while the ETFs have certainly ramped up price, ETF buyers as a behavioral unit might behave quite differently than people in the past, right? ETF buyers are going to be a bit more, I don't know. I've heard arguments on both sides. You could have people that say, ETF buyers are just going to be more price sensitive. They're not diehard Bitcoiners that are going to just buy and hold the asset forever. They're going to take profit, much quicker than a traditional long-term Bitcoiner would. They're going to sell much quicker than a long-term Bitcoiner would. So you might have these shorter, quicker sell-offs, but also shorter, quicker bursts up in price. Then again, you also have some people that are ETF buyers that are just passive. They just buy the ETF and leave it alone and put it in programmatically. So Bitfinex analysts said in a January 6th market note that sell-side liquidity in Bitcoin markets is shrinking at a rapid pace, and the worst of the downward pressure on its price has likely passed. Of course, now we know that wasn't true. It's actually dropped quite a bit since then, but I think he's saying the speed in which it's dropping. Analysts, however, are predicting that Bitcoin could be set up for a huge record rally this year, buoyed by expected pro-crypto policies from the incoming president, Donald Trump, and nation-state adoption of Bitcoin. So we still have a lot of wind at our backs here, even though we have these short-term drops. And so the narrative is that Bitcoin dropped because the Department of Justice just got the green light to sell a third of U.S. Bitcoin holdings, which kind of screws the idea of the strategic Bitcoin reserve with its full total amount we were hoping for. But really, I think what did it was probably more just the Fed interest rate concerns. So Bitcoin price could it dips to 92.5 caused by federal interest rate concerns. So the Fed monetary policies drop Bitcoin a bit lower. The dip to 92.5 was mainly triggered by growing concerns over the Federal Reserve tightening monetary policy for 2025. So a lot of people are addicted to cheap money. They want really low interest rates and more money printing because that begets asset prices going up. The problem is that relates into results in a bunch of inflation. So Bitcoin's dip stems primarily from strong U.S. economic data pointing towards potential interest rate hikes. This development makes cryptocurrencies less attractive as investments, while the Federal Reserve signals of tighter monetary policy further intensify market corrections. So signs of the economic resilience, good things in the economy, have delayed expectations for a potential rate cut by the Federal Reserve, which makes sense, right? If things are looking really good, you don't need to cut rates. You keep rates high and see how the market responds, as much as we want them to cut rates and pump our bags. With markets now expecting the first lending rate cut to occur June 18th. So we're not back to this whole thing of, from summer on where we were getting a cut every 6 weeks. So according to the latest estimates from the CME Group's FedWatch tool. So the market is betting on we won't get another cut at least for 6 months and one, maybe two cuts this whole next year. So rates are going to remain elevated.